Let's now consider how easy it would be for an individual country to leave the Eurozone. As we'll see, it's not going to be that easy at all. If a country leaves the Eurozone, it would probably mean, at a bare minimum, that first that country would reintroduce a new currency or scrip. This probably would be done to continue paying state employees and pensioners if the government otherwise ran out of money, and also that over time some assets and liabilities would be redenominated in terms of the new currency. At the very least, there would be a risk of such redenomination. For fiscal reasons and to keep its banks solvent, a government leaving the Eurozone may also redenominate bank-based liabilities away from euros in terms of some other new currency, such as a new drachma or peseta. The problem, of course, is bank runs, and these bank runs will start even before the country in question leaves the euro. Why would you leave your funds in a relatively insolvent Greek bank or Spanish bank if you feared redenomination risk, when you can take those same funds and send them to a bank in Germany? You can still use the German bank for all of your electronic transfer payments. So what happens is the banks in the troubled country become hollowed out over time. There is bank runs and capital flight, and this of course leads to a contraction of credit and falling output and employment in the afflicted country. As national output goes down, government revenue goes down, solvency problems become worse, and that in turn only accelerates the bank run. This problem with bank runs will affect many other sectors of the economy. If there's a general credit squeeze or liquidity squeeze, one thing people do is they simply stop paying their bills. Furthermore, they wonder maybe the bills will end up being redenominated in terms of the new and cheaper currency. So commercial credit tends to freeze up, and again, economic activity tends to slow down. A country leaving the Eurozone might use capital controls to stop euros from leaving the country. But that's tricky. For instance, euros could leave the country simply in briefcases or cars. That means patrolling the border, which could be difficult, but it's also inconsistent with EU law. It also means that bank accounts have to be frozen. Otherwise, people just take their cash out of the bank and travel abroad with it. But if bank accounts are frozen, then cash isn't available for a lot of regular daily transactions, and that's an economic problem. Maybe the biggest issue is that once you put on capital controls, how do you pay for exports? A lot of countries import quite a bit of their food, their fossil fuels, and their pharmaceuticals, and they do that by sending money, hard currency, in this case euros, abroad. If they can't send euros abroad, it may be a lot harder to buy food, fuel, and pharmaceuticals for the country. And you might say, well, let's make exceptions. Let's allow euros to leave the country for quote-unquote essential purposes. What you'll get then is a lot of phony invoicing. People sending euros abroad, making up a phony invoice, claiming they sent it abroad, say to import food, when in fact it was simply a case of capital flight. In the midst of a financial crisis, with countries which maybe aren't so good at collecting tax revenue in the first place, stopping all this phony invoicing probably isn't all that practical. Another big issue is contract redenomination risk. Let's say you wrote a euro contract and you wrote it in terms of euros, and now the currency has been changed. Do you still owe euros? Well, if you still owe euros, the question is, where do you find the euros to pay? Keep in mind that now you are being paid in terms of drachmas or pesetas or some other weaker currency, so you'll have a large number of people going bankrupt all at once. Alternatively, you could say these contracts now require the payment not of euros, but of the new domestic currency. But if that's the case, contracts now have been broken, and everyone is afraid that in the future contracts will be broken again. Trade will slow down, the costs of doing business will rise, and especially internationally, everyone will be afraid they're not going to get hard currency, but they'll get only the new domestic currency. This would have a seriously negative economic impact. And in any case, a lot of the European legal systems simply aren't up to having to handle so many cases at once. Keep in mind, these aren't just problems with actually leaving the euro. These are problems a country experiences as the fear increases that the country might leave the Eurozone, whether or not that country leaves the euro. Once redenomination risk becomes a possibility, once the redenomination of bank accounts becomes a possibility, you have higher uncertainty and you have credit contraction and you have falling output and employment. This is part of the problem with the Eurozone. Once people start doubting it, it's hard to get them to stop doubting it. Or to put it another way, it's much easier to break trust than to reestablish it. Is there an actual number for all of these costs? When economists get together and speculate about the costs of leaving the Eurozone, it's common for them to cite a figure of, say, 30 to 40% of GDP of a country being lost in the first year of leaving the Eurozone, due largely to financial panic, the commercial legal system breaking down, capital flight, and credit contraction. That's pretty high, and it makes it easy to see why, even if a country is regretting having entered the Eurozone, it still might be quite reluctant to leave.